Johann, thanks so much for joining us. It seems like the market likes the numbers that came through. Strong numbers are coming off, I suppose, on the trading side, a low base, but they really are starting to reap the rewards of increased lending.
Yeah, I was actually slightly disappointed by the numbers, and because first of all, it was quite light on detail, except for the capital numbers. We didn't really actually get numbers out of them.
All they say is an improvement in business lending margins, net interest income up.
Absolutely.
So I was looking for the numbers to see how far they've gone up.
But what you can actually back out from it, the fact that they say that the cost to income ratio deteriorated, logic would dictate that revenue grew slower than costs. And, if you look at cost growth, call it 10%, so revenue probably grew slower than 10% in the period under review. So I think it's maybe slightly disappointing. Consensus looking for full year a bit stronger than that. And they also highlighted that there's a bit of an uptick in bad debts coming through, which was quite interesting. I think, that's a function of coming off quite a low base in CIB, the corporate arm of Standard Bank. So coming off quite a low base there, normalizing there. And I think, if you look through the numbers there, you might start seeing an uptick in retail bad debts as well. They're putting through portfolio provisions, which is basically building in fat a bit. So for leaner times going forward. So, I don't think it was such a positive trading update, actually.
You said that they've been trying to grow into the mortgage space and be more aggressive in that space, and in fact overtaking ABSA right now. Is that why we've seen an improvement in the margins?
Yeah, well, I think they probably, the margins, I think, there's obviously different components to it. There's a mix change coming through for most of the banks, except Standard Bank, where most of the banks are migrating towards more unsecured lending, obviously high yielding asset class. But for Standard, I think what was interesting, if you actually saw expansion in the margins, it's not so much in mix, it's an actual improvement in lending margins to consumers. And they've been guiding the market that they're actually writing mortgage business at quite decent spreads at the moment, much better than coming into the downturn.
So if this is a disappointing update for you, where is the growth from Standard Bank going to come through from right now? Are you concerned, as we pointed out, an ROE below the average peer in the banking space? They have a high cost-income ratio. I mean, where's growth coming through from Standard Bank? Are you encouraged at all about their prospects?
Well, look, they've got a brilliant franchise in South Africa, and they've got a presence in most of the sectors. They've got a market-leading or second position in most of the sectors. So brilliant franchise in South Africa. The ROEs is being depressed by the operations outside of South Africa. I don't necessarily think that's a bad thing. They've got a brilliant footprint in Africa. They've paid their school fees in Africa, so they're probably ahead of the curve in terms of African expansion, which will obviously drive growth for them. But as a rule, I'm not overly excited for the growth prospects for the banking sector. Our team has got the banking sector on a hold, except for Nedbank, which we've got on a sell. Not anything wrong with Nedbank, but just the pricing perspective. No. So, the banks look pretty full to me at the moment. But having said that, we've seen this massive change from expectation 2 months ago of interest rate hike coming through later this year, early next year, to people talking about the cut now. Obviously, the slowdown in Europe having an impact there. And banks benefit in an environment where interest rates are coming, or inflation is tracking down.
And Daniel Manele, well, we have to also take the rand into account, but let's not go there because the oil price is coming down. But Daniel Manele from the central bank coming out today saying that Basel III will impact monetary policy. It's going to force banks to cut back on lending. And that, of course, is a factor that we have to consider, is banks have to meet capital requirements. How solid is Standard Bank right now when it comes to those ratios?
Yeah, that's a bit of a concern, not really necessarily a concern, but they're towards the bottom of the peer group. Them and Nedbank sitting at about the 11% core tier 1 ratio, which is the new golden benchmark to look at in terms of capital ratios, whilst you've got ABSA and First Rand sitting closer to the 13% level. And there was an interesting story coming out today on the newswires, because there was a resolution approved at Standard Bank's AGM that happened today, hence the trading update, saying that they're going to be doing share buybacks. That's not really the case. It's one of those rubber stamp kind of resolutions that needs to be approved to place the capacity for directors to do share buybacks if the need do arise. But at these levels, I don't think that Standard Bank has got surplus capital to do any share buybacks. The Core Tier 1 ratio actually deteriorated from 11.5% to 11%. So I don't really think there's any scope for share buybacks or any return of capital to shareholders.
Well, management has confirmed that in a statement. So thanks so much for joining us and unpacking some of the numbers that we saw. Well, we didn't see numbers coming through on the outlook in terms of earnings for the 4 months, but we saw those capital adequacy ratio numbers coming through from Standard Bank. That was Johann Scholtz, banking analyst from Afrifocus Securities.